Hi everyone, Maria Toll here again. In today's video we're going to go through the ratios that you'll have to do as part of your assessment too. The first section I'm going to explain about the theory behind the ratios, and then in the second section I'm going to go through and show how we calculate them and analyse them. So the first section, I'm going to play you my theory component from last year's lecture because I did a pretty good job of it, and then I'll come back and we'll go through the calculations using this year's figures for Wesfarmers. So ratio analysis hopefully will provide us with a little bit more insight into the business just by using its financial statement. And we do this because we're trying to figure out or glean mathematical relationships between the financial statement figures. So it is mathematical, it's a calculative analysis, and we use the financial statement data, so it's using the historical data, and hopefully we're trying to identify, we're just comparing one figure to another. And we call that a mathematical relationship. So for example, the very first ratio that we'll look at is called the net profit margin. We're simply comparing net profit to sales and looking at the relationship between those two figures from the income statement. So for every dollar of sales, how much are we turning into net profit? So that's the net profit margin. So ideally you want a higher net profit margin because you want to be turning most of your dollar into net profit. Unfortunately, in the real world, it doesn't work that way. So, but we're just looking at the relationships. Now we do group them into three main areas. So we have profitability ratios designed to show us how profitable, or to give us indications of how profitable a business might be. We have liquidity and efficiency, showing us how liquid or can they pay their short-term debts, and how efficient are they using their assets. So liquidity and efficiency ratios give us indications of those. And long-term solvency or gearing, which is how have we structured or financed the structure of our company. So have we predominantly used outside or external debt, or have we funded it through owners' share issues and so forth. So long-term solvency is the third main group. In our particular unit, we separate them into original or general ratios, and then of course we have our specific restated ratios from which we'll use the restated financial statement data. So in this unit, the ratios that we will actually use, we won't use all the ratios that I'm going to go through, but I find that they're quite useful, and I'd like to go through more than just what we use in this unit, just to give you a bit more of a complete picture. It's by no means comprehensive. There are a lot more ratios out there, and you can even make up your own ratios as well, because really a ratio is just expressing a mathematical relationship between two figures, or two or more figures. So in this unit, I've highlighted the names of those ratios in red, just to give you an idea of that's what's going to be in your spreadsheet. So in general, so these are the general ratios. I'm going through the general ratios first, and then I'll go through our restated ratios at the end. So the general ratios, which we'll be using our original financial statement data for, starts with the profit margin, which I explained before. It's for every dollar of sales, how much are we turning into net profit? And return on assets is very similar. For every dollar of assets, how much are we turning into net profit? So what return are we gaining for investing our money into the assets of this business? So again, with these two figures, you do want to see it higher. Higher is more favourable. Return on equity, same concept again. What return are we getting for the equity that we're putting into this business? So again, you do want to see a higher figure. Now, we don't calculate this particular ratio in this unit, but we do calculate this in the restated ratio. So I'll cover that when we go down, but the concept is the same. Okay, continuing on with profitability ratios. These profitability ratios are more to do with shareholder returns, so we call them market ratios. So earnings per share, now your companies actually calculate this for you, but we don't want you to use the company's calculated one because they tend to round their number of shares. They show you their calculation anyway. It will be slightly different to the one that you calculate, and we want to see your calculation because that shows your understanding of it. But essentially this is for every dollar that we've put in, for every share, how much have we earned for that share? So if I own one of the shares in Wesfarmers, how much has that share earned for me this financial period? So it divides our total profit by the total number of shares issued. So total profit that Wesfarmers has been able to generate for this financial period divided by, or spread across, if you like, the total number of shares on issue. So every single shareholder, if if Wesfarmers was to distribute all of the profit to all of its shareholders, how much would every single share earn? How much would everyone get? So that's earnings per share, and that's actually a very commonly quoted figure in the financial press. So earnings per share, and it's also part of why it's included, because it is so commonly used. It's automatically included, or the companies have to calculate it and include it on their income statement. So you would have noticed it. We didn't enter it into our financials, so that was the section I said just ignore, don't enter that in, because for our unit we want to calculate that ourselves. We don't want you to use the one that your companies have already calculated. So if this is how much the company could have paid out per share, then why didn't they pay this amount out per share? This is what this tells us. So dividends per share is how much the company actually paid out of the earnings. So let's just assume, say earnings per share was $1.50 per share. So for every share on issue, they could have been paid $1.50 as a return, but the company may only have paid out 50 cents per share. So they're actually retaining some of the earnings and not distributing it as dividends, because they want to invest in the assets in the future, or the company's operations. So companies, it's very common to have a larger figure for earnings per share and a very small figure for dividends per share. Now, Wesfarmers actually pays out a significant amount of dividends, and you'll find that larger established companies do that. Startup companies or smaller companies, or companies that haven't been operating for that long and don't have quite a strong asset base yet, they generally won't pay any or very large dividends. They will pay smaller dividends, if any dividends at all. And of course, if the company is making a loss, i.e. they have negative earnings per share, they won't be paying any out in dividends. So I think Virgin Australia now, for a number of years, they were making a loss and they did not pay any dividends. So earnings per share is the earnings per share, so profit divided by number of ordinary shares. The dividends per share is dividends that were paid divided by number of ordinary shares. So how much they earned per share, how much they actually paid back to the shareholders per share. Price earnings ratio, now this means different things to different people. Actually, all the ratios could mean different things to different people. I'm just explaining my view of them. But price earnings ratio is a bit of an interesting one, because I used to explain it as, I see it as a measure of inflation of a share. So when I'm doing my own investing or looking at companies in terms of for my super fund, I don't like to see a higher price earnings ratio. I prefer lower price earnings ratio, because if I see a higher one, to me it's more inflated. Now, a manager, one of my students I was teaching the MBA to a number of years ago, he said he prefers a higher price earnings ratio, because he looks at price earnings ratio in terms of expectation about future profitability. So if he sees a higher price earnings ratio, to him that means, well, people must be expecting good things of this company, or the market price wouldn't be so high in relation to its earnings. So he prefers a higher price earnings ratio, and it does encompass all of that. So price earnings ratio is really a comparison, as the name suggests, of the market price to the earnings of that company. So that's why it's called the price to earnings ratio, price earnings ratio, or PE ratio that we commonly call in practice. So it literally takes the market price of the share and divides it by the earnings per share, this figure up here. Now, one of my students, I was explaining that every year, I explain it like that. One of my students a number of years ago said to me, "You just confused me with your explanation. It's really simple." Price earnings ratio to him, when he looked at comparing the market price to its earnings, he said, the price earnings ratio simply tells you how long you're going to be paid back for your investment. So he says, for example, if I invested $5 into this share and it paid me $1 back every year, then it would take me 5 years to be paid back for my investment in that share. And I thought, actually, that's a really good way of explaining it. So have a look at the mathematical relationships between these figures and make sense of it for yourself. That's what we're asking you to do in your assignment. So I'm going through and I'm telling you my understanding of these ratios, but you might find an easier or more basic or novel way of explaining it so that others can understand. And that's what we're looking for. So for that student, explaining it in that way, that was a spot-on way to explain it. For me, that was a 5 out of 5 explanation. So So price earnings ratio really just compares market price to the earnings of that investment. And however you want to interpret that, I'm looking forward to reading in your assignments. But essentially that's it. So price earnings ratio is a measure of inflation, how inflated a share is. It's also a measure of how long the share is going to take to pay you back based on these earnings per share. This denominator here, the bottom figure, is actually this ratio that we've calculated. Dividend yield is sort of like your term deposit interest rate. So it's what dividends you did get paid back for your share divided by the market price, divided by the investment amount. So it's like I said, like your term deposit. If you think about it conceptually, it's the interest you earned on your term deposit divided by your term deposit investment amount. That'll give you the percentage interest rate. Dividend yields the same things. The dividends you got paid divided by the investment amount, which is the market price for that share that yielded the dividend amount. So it's a percentage. So again, the dividend yields is the dividend rate that was paid back to you for your investment. So it's your investment rate. So again, you do want to see this higher. It generally isn't very high because companies, like I said, prefer to retain their earnings rather than distributing it back out to shareholders. So dividend yields, think about it in terms of interest rate, return on assets, return on investment. Dividend payout simply compares these two figures to each other. So it says how much, well, what percentage did they actually pay out of what they could have. So this is potential 100%, what could be paid out, how much did they actually pay out. So if you actually divided these two figures together, you would get the same figure as the dividend payout figure anyway. And if you look at it mathematically, the ordinary dividends is already here as the numerator, and the net profit after tax minus preference dividends is the numerator here. And again, that just shows one divided by the other. So the dividend payout compares what could have been paid out with what actually was paid out. So we only look at the first three for this unit, or we only calculate the first three for your firms in this unit. So that's profitability ratio. So the previous slide where we went through the general profitability ratios, we look at these two in this unit, and the shareholder and market profitability ratios, we only look at the first three in this unit. Okay, moving on to the next group, which is our liquidity and efficiency. So liquidity looks at, can we pay our short-term debts? Do we have enough cash and short-term assets to pay our short-term liabilities, our immediate liabilities? That's liquidity. And efficiency is how efficiently are we using our assets? Are we overworking them or are we underworking them? So obviously we want the nice balance, equilibrium in the middle where we're not overworking them, we're not underworking them, but we're using them at the most efficient point as possible, you know. Economics and where the lines meet. So we're using them at equilibrium they're most efficient. So first of all, liquidity. So current ratio tests liquidity, and it simply compares current assets to current liabilities. So for every dollar of current liabilities, how many dollars of assets do we have to pay? So at least you'd want to see 1-to-1 at least with current ratio. You want to see at least, if you've got $1 of liabilities to pay, you want to at least have $1 of assets, current assets to pay that with. And it's interesting to note actually with ABC Learning Centres a number of years ago, their current ratio was manipulated to show that they had enough current assets by reclassifying some non-currents to current. So they wanted to show that they had enough current assets to pay their current liabilities. This current ratio is commonly linked in real life to a lot of loans, particularly business loans. So a business, especially a new startup business, that the bank might say, well, we actually require, before we say you must pay us this money back, before they start foreclosing, we require a certain current ratio, say 2-to-1. So for every dollar of current liabilities, we require you to maintain at least $2 of current assets. So this is a really important ratio that's used in practice. You'll probably come across this if you work in the banking finance sector in the future. So we do calculate this in this unit, it's in red. The quick or acid test ratio is more of a stringent test than the current ratio. Essentially, it's the same thing. It measures for every dollar of liabilities, how many cash assets do we have? So it says, okay, let's take our more stringent current assets. Let's not include all current assets. Let's include just cash and short-term money market equivalents of cash and accounts receivable. So assuming that we can call up our customers that owe us money and actually ask them to pay that cash, which is also questionable. But anyway, the quick or acid test ratio just takes more stringent current assets and divides it by our current liabilities. So again, another measure of short-term liquidity. Our receivables and inventory turnover and assets turnover, this is measures of efficiency. So how efficiently are we collecting money from our customers? How efficiently are we selling our inventory? And how efficiently are we utilising our assets to generate as profit? So essentially that's what these measure or give us an insight to. So receivables turnover tells us how quickly we are receiving our money for making our credit sales. So we obviously sell to credit, to our customers on credit, we let them pay later. So it compares our net sales revenue with the average amount that's outstanding for these customers to pay us back, our credit customers. So how quickly are we turning over our receivables? How quickly are we collecting our money? And you can make that into a number of days figure by dividing 365 days by the receivables turnover figure. That will tell you how, on average, how long it's taken you to collect your money from your customers. Inventory turnover, same concept. How quickly are we selling our inventory? So from the point where we actually purchase our inventory to the point where we actually turn it into a cost of sales, where we actually sell it, how long is that period? So again, the inventory turnover figure simply states how often we are turning over our inventory into sales, and that, again, you can see that in the mathematical formula. If you divide the inventory turnover figure into 365, you'll get this figure, days inventory, and that's what we actually calculate. So we do the average inventory, average daily cost of sales, this is where we put the 365 in, and I'll show you how to do that when we actually go through our company spreadsheets. So number of days inventory, how long is it taking us to sell our inventory from the time we purchase it to the time that we actually sell it. The asset turnover is a measure of how efficiently we are utilising our assets to generate sales. So how often are we turning the value of our assets, of our average total assets, into sales? How often are we turning that dollar figure over into sales? So again, with all of these, you generally do want to see a quicker figure because a quicker figure means, with the receivables turnover means that you're collecting your cash quicker from your customers. With the inventory turnover, it means that you are selling your inventory faster. And with the asset turnover, it means that you are using your assets to generate sales faster, or a lot more sales. So generally you do want to see high figures, but you don't want them to be too high, because if it's too high, for example, you might be overworking your assets, and that's not sustainable, and that could lead to longer or larger costs in the long term. So you don't want to be overworking your assets, you just want to be working them sustainably. So yes, we'd like to see larger figures, quicker figures, so bigger figures here, which means more faster turnover, but not too fast. We should always be benchmarking against industry. So that's liquidity and efficiency. So the first two on liquidity and the last four on efficiency. Now in this unit, we only do the current ratio for liquidity and the last two for efficiency. The last group of ratios that I'll cover is the financial stability or solvency or long-term financial structure ratio. So how have we geared our company? Have we predominantly funded our assets with debt or external borrowings, or have we predominantly funded it with owner-generated funds such as shares? So with long-term stability, we calculate a debt and an equity ratio, which simply measures what proportion of your assets are funded by debt or equity. So both of these ratios should add up to 100%. Because if it's not funded by debt, it's got to be funded by equity, or vice versa. So for example, if you have a debt ratio of 40%, your equity ratio will be 60%. So you can see your total assets is both a denominator figure here, the bottom figure, and then on the numerator, the top figure, it's liabilities or debt and equity. And again, if you think about your balance sheet equation, assets equals liabilities and equity, you can see that whole picture of the pie together in these two ratios. So debt ratio plus equity ratio always has to add up to 1 or 100%. The debt equity ratio is different to each of these. It compares one to the other. So the debt ratio, debt ratio is this one, the equity ratio is this one. The debt equity ratio takes those two and compares them to each other, so divides one by the other. So if we continue our example of 40% here and 60% here, if you divided the 40% by 60%, you would get 0.67, which means for every dollar of equity, 67 cents is being put in to fund the assets of the business by an external party, such as a bank. So it compares, the debt equity ratio compares the debt to the equity component. So it says for every dollar of equity, how much is being put in by a debt, external debt, or the bank, or some other external financing. So debt equity ratio is different to these two. That's very important. A lot of people think they're the same. They're not. Times interest earned is simply how many times does our profit cover our finance costs, essentially. So we use earnings before interest and tax rather than net profit after tax, because again, for management purposes, interest is a financing function and taxation is generally out of the manager's control. So they use profit before interest and tax usually. So earnings before interest and tax divided by all of our finance costs. Finance cost expense and finance cost capitalised, because sometimes companies capitalise for accounting reasons, finance costs on the balance sheet. So finance costs on the income statement and finance costs on the balance sheet, add them together, that's all of our finance costs all together. How many times does our profit cover this figure? So again, you want that to be higher, because that means you've got a higher profit to cover your earnings. And again, if you find that your company doesn't even generate enough profit to cover your interest costs, they've got problems. They're probably too heavily geared, too much in debt, and that can be a problem with long-term solvency. They may not be able to pay their debts as they fall due, and the company may actually have to be wound up or closed. So times interest earned is a pretty important long-term financial stability indicator. Now in this unit, we only calculate the equity ratio and the debt equity ratio. So that's our general ratios. Now I'll just cover our restated ratios. So there's only 6 of them, 6 restated ratios. And again, they're pretty much the same concept to what we've covered already. And you can actually, in your assignments, I expect you to compare one with the other, because that's the whole point of restating. Our original financials were how our companies presented them, and our restated financials are restated in terms of operating and financing. So the ratios I've just been through are based on our original financials, and the ratios I'm about to go through now are based on our restated financials. So we should be able to see the difference between the same ratios using different financial statement figures, and hopefully glean some further insights from that. So again, our return on equity I covered up above in our profitability ratios on the first slide. So it's this one. So we don't calculate this one in this unit, but we do calculate it for the restated ratios. So we use comprehensive income and average ordinary equity. So CI, this is what we put in brackets, and that's why I said you can see a lot of the acronyms on this slide. And when we were entering and restating, doing our restated financials, I said make sure you put in brackets your acronyms, because it will be so much easier when you come to calculate these ratios. Just looking at this acronym, I need OI here, so click into the OI cell, wherever you've put OI, click into the NOA, click into your RNOA, your NFE for your net financial expenses, and so forth when we go through on the next slide. So hopefully you've used your acronyms. It'll make life a lot easier. So return on equity, how much return are you generating for your shareholders? So we're looking at comprehensive income, dividing it by the average ordinary equity. So again, you want to see a higher figure here. Higher figure is more favourable. Return on net operating assets is same as return on assets that we looked at in the profitability ratios on the first slide. So return on assets, again, looking at the return for the use of your assets. So how much of for every dollar of assets, how much are you generating in profit? And that's the same concept with our restated return on net operating assets. How much are we generating, how much profit or operating income are we generating from our operating assets? So again, you want to see a higher figure. And talk about the comparisons, because you calculate both of those. So you calculate the return on assets using your original financial statement figures, so you'll get a percentage figure there. And then you also calculate the RNOA, or the return on net operating assets, using your restated figures. So compare them. Is one higher than the other, and why? Look at the inputs. So we calculate RNOA here. Profit margin, again, we've looked at that in the first slide. So we use the operating income divided by our sales for our restated ratios. Originally on our general financial statements, we looked at that here. It's again our profit divided by our sales, but from our original financial statement figures. So for every dollar of sales, how much are you turning into profit? And we calculate that for the original financials. We also calculate that for the restated financials here. So you should be able to compare one to the other. Is one higher than the other? Why? Look at what have we done between the original and the restated? We've separated into operating and financing. So we've left out the financing items. So has that made a difference to the profit? Is our profit margin higher from our operational assets? So this is all very interesting. You can have a look at your firm and see what further insights you can glean. Now, economic profit I haven't covered yet, but in the study guide, it is covered in a lot of detail. And if you've studied economics already as part of your degree, or if you've done any other studies into economics, you'll have an understanding of this. But essentially, economic profit covers opportunity cost. And opportunity cost is the cost of the next best alternative. So what you would have been able to put your money into if you hadn't gone with your current decision. So it looks at making a profit to not only cover the funds invested into this particular decision, but also to cover the cost of not investing in your next best alternative. So we call that opportunity cost. So economic profit takes into account the cost of capital, so that opportunity cost. And you can see it factored into the equation here actually. RNOA, which is our return on assets, that's RNOA. And you have to explain that as part of your assignment and into its drivers, but more about that later. So RNOA, take away, so this is a percentage figure, or can be a percentage figure, take away your weighted average cost of capital, so I call it a WACC. Your weighted average cost of capital is the very commonly used acronym in the real world. And again, companies actually have a set WACC usually. So the study guide tells you can actually just use 10% for this, but I would encourage you to have a look at your company's annual reports and just see if they have their own WACC that they use, their weighted average cost of capital. And if they do, use that instead and write about it to your market, so your market knows that you've actually taken an understanding of the weighted average cost of capital and had a look and found it, that your company uses it. Now, sometimes a company won't tell you, or they'll say, look, we do use the weighted average cost of capital, but they don't list it. In that case, just use 10%. 10% is the easy option. And so we say, okay, so this is the return that our operating assets is generating us. Take into account, so take away the cost of capital. So that's the extra profit that we're generating over and above our cost of capital. And then multiply that percentage figure by your net operating assets to get our economic profit, just to make it into a dollar value, essentially. So this is percentage, this is dealing with decimal points and percentages. So our return that we're generating, take away our cost of capital, so covering our opportunity cost. This is the amount of return or profit that we're generating greater than our opportunity cost or our cost of capital. So this is the profit over and above it. And then turn that into a dollar figure by multiplying it by your net operating assets from your restated balance sheet. I left the divided by 1 there because I couldn't format out this line. So divided by 1 is just leave it as the top line. So if you've got negative or a very small return on net operating assets, i.e. less than your weighted average cost of capital, so you might have a negative percentage figure here or a negative decimal figure here, then of course your dollar figure is also going to be negative. And that's fine, because you know that you expect it to be, because you've got a very small return or a negative return here if you've actually got a loss instead of operating income or profit. So always explain and analyze your figures looking at your inputs, because what might be for one company might not be for another. And one company might have a profit, one company might have a loss, and so forth. Okay, so that's economic profit. That's our profitability ratios for our restated financials. Now we'll just have a look at a ratio under financial stability and one under efficiency for our restated ratio. So you only have to do six ratios for your restated financials. So we have a look under financial stability at net borrowing cost, which again is, think about it in terms of your interest rate on your loan. So when you go out to get a home loan, they say, okay, we'll lend you this money and we're going to charge you an interest rate on your home loan of 7%. Okay, so this is what this calculates it. It calculates your interest rate, if you like. We call it the net borrowing cost. So it says, what's your finance costs after tax, and what was your total borrowings, your net financial obligations, so NFO from your restated balance sheet. So this was our net finance costs after tax, and this is divided by, so we're saying how much interest have we paid, how much did we borrow. So essentially it gives us an interest rate. And then that would be really interesting to compare to your firm's loan rates, because some firms in their financial statements will actually disclose how much they're paying in interest on their loans, on their long-term borrowings in their notes. So you can actually say, well, I've calculated their net borrowing cost at 6%, but they're actually paying 7% on their loans. So actually this is really good. They're not paying as high. Essentially on their financial statements, their net borrowing cost isn't as high as their loan cost. Or you might find that their net borrowing cost is a lot higher than the interest on their loans. So it's not a true indication. So the 7% interest is not a true indication of all of the costs of that borrowing or of that debt. So again, so this can be quite interesting, but that's what it calculates. And under efficiency, how efficiently are they using their assets? Same concept as what I explained under the efficiency ratios for the general. On the second slide, I think it was. Yeah, so this one. So the asset turnover, how efficiently are we utilizing our assets, using our general financials? So the same concept under the restated, we're simply using sales and our net operating assets. So we're leaving out the financing assets from here. So how efficiently are we using our operating assets to generate sales? For every dollar of operating assets, how much are we generating in sales? How often are we turning over the dollar value of our operating assets into sales? So again, you want to see a higher figure. You don't want to see it too high because that might mean that we are overworking our assets. So compare this figure to your asset turnover that you calculate for your general or original financial statements and see, is there any difference? And if so, explain it. And that's what we're looking for in your assignment. So that's pretty much all of the ratios. I know that was a little bit dry, but hopefully that's given you a bit to talk about in your Word documents when you actually have to go through and explain all of your company's ratios. Please use your own words, so understand each one and then explain it in your own words. There's a number of limitations of ratio analysis. It is performed on historical data. It's not used on forecasted data. We use it as a measurement base. Year-end data might not be representative of what actually happened during the period, because the balance sheet only shows a snapshot as at one point in time. There is a general lack of disclosure in our general purpose financial reports, and again, you'll probably find that when you're going to look through for prices such as your market price and figures, such as your market price and so forth. So there is a general lack of disclosure. There could be some one-off or non-recurring items that's skewing your figures. This is actually a really important one. In 1 year, there may have been, for example, discontinued operations, which made a huge loss. And so when you calculate your ratios for all 4 years, you'll see nice profits. And then that 1 year will be this huge negative figure. And you'll be like, what did I do wrong? You go back and have a look. And that'll be that one-off, non-recurring, hopefully non-recurring item that has skewed your figures. So when you're explaining that, write about that in your assignment. Say, well, it's actually huge and negative because they had discontinued operation in that year. They realized it was making a loss, and so they got rid of it. And so that's why there was a huge loss in that year. And then the next year they generated a profit or whatever it is. But just make sure that you are, if there is 1 year that looks funny, 1 or 2 years, investigate why. So ratios are just little red flags that indicate something might need investigating. So just because we look at it and we say, oh, well, this is good or this is bad, it's not necessarily the case. It's just an indication saying you might need to investigate to see if it is good or if it's bad. And of course, some entities just may not be comparable. They're in different industries, different economic climates and so forth. So there are a number of limitations, but generally it is useful. And if you just realize that ratio analysis simply shows you mathematically a relationship between two figures on the financials, then hopefully that will help you in your understanding of what you can use it for, and you don't apply it to outside its scope, essentially. Okay, so tips for us when we complete our assessment, the ratios component. There's a few preparation items that I would like you to do to make life easier when you're actually calculating the ratios. Identify the number of issued ordinary shares. Usually you can find this in your PDF annual reports. Identify the market price of your shares. Sometimes your companies will disclose this in their annual reports, sometimes they won't. If they don't, you need to go onto a main website, so any sort of finance or stock exchange website. So for example, the Australian Stock Exchange, or Yahoo Finance or Google Finance, because they all list market prices of shares, and usually you can type a date in of a company on those finance sites, and they will actually show you the share price as at that date. So if your company doesn't tell you in your annual report, then you may have to look elsewhere for the market price of shares, but identify this first. And also identify your cost of capital. Don't spend too much time on this. Just have a quick search through your company's PDF documents. If you can't find it, just use the 10% suggested in the study guide. But do state that you have had a look so your market knows that you were a bit proactive and tried to find your company's weighted average cost of capital. Your ratios must be fully linked. Do not type anything into your ratios other than a formula. And I'll show you as we're going through how we can put these in a little working section down the bottom and link to those as well. So if you've accidentally made a boo-boo with one of these, you can correct it down here and it will flow through everywhere you've linked that above. So make sure that it is fully linked. All your ratios need to link to the original financials except for your restated ratios, which should be linked to your restated financials. So all of these ratios need to be linked to your financial statements tab, your original financials, and then all of these ratios need to be linked to your restated financials tab. So make sure that you are linking the whole lot to the correct set of financial statements. Okay, so now we're going to complete the linking. So take the time to pause the video and go and get your PDF reports, get your completed company spreadsheet up to your restated income statements. So you should have completed all your restating. Use your completed company spreadsheets. Go and get your annual reports, because we'll need to look through those for number of ordinary shares, market price and cost of capital. And make sure you've got access to the internet to search out market prices of shares if your company doesn't tell you what those are in the actual annual reports. All right, so pause the video now, go and get those and come back and we'll do the ratios. Okay, so let's get into it. Before I do, I've just realised I forgot one small key item in all of my other videos, so I'll just quickly go and correct it in the spreadsheets now. It probably doesn't make too much of a difference previously. I mean, it would be nice if I'd got it right at the beginning, but it will make a difference for the ratios section. So just go through your spreadsheets right at the beginning, very, very, very beginning, when I was first customizing the spreadsheet. I customized the name, the balance date and the year, and I forgot to customize the denominational currency that our financial statements are denominated in. So you only have to change it once and it flows through the rest of the document, thank goodness. So I'm just going to go back. Now you'll know what your company's financial statements are denominated in because they'll list it in the actual financial statements themselves. And I know mine are in millions of dollars for Wesfarmers, so I'm just going to change that to millions of dollars here in my spreadsheet. And that literally flows through everywhere in my original financials, as well as through to my restated financials as well, which is good because I'm going to need to link to both of those for my ratios section. Now, again, if you're not sure what your financial statements are denominated in, which hopefully you should by now, you can always go through to your financial statements and have a look. Sorry, page 100 in this report. And it'll actually tell you, for example, Wesfarmers are in millions of dollars. So you can see that your company, whatever denomination your company's figures are presented in, is what your spreadsheet should be also presented in. So just fix that now. I should have done that right at the beginning when I was entering the financials, and I've just realised it now because it actually makes a difference with your ratios. So be aware of what your figures are denominated in. Okay, let's pick up now for ratios. We have to do a little bit of preparation, which will make our life easier, again, like we've been doing all along. So we're going to identify the number of issued ordinary shares, market price, and cost of capital. So the number of issued ordinary shares is not the dollar figure of ordinary shares. So a lot of students think, oh yeah, just go to my balance sheet, look at the share price or the issued capital and put that dollar figure in. That's not what we're looking for here. We're actually looking for the quantity of shares on issue, so the number of shares, not the dollar value of those shares, but the actual number that are issued. So I always say go to your annual report first. So if we just went back to the first page my 2018 report. Again, I just look through the 2018 and the 2016 report to give me the 4 years worth, but you can look through every annual report. Now, most annual reports will list it under the balance sheet note, so sorry, the equity item in the balance sheet, the note to the equity. So if we just go, I'll just flip back to the financials actually, go down to the balance sheet and have a look at equity. There usually be an item of issued capital, and when they actually explain about that item, they usually will tell you the number of issued shares as well. So if you can go to that note, usually make your life easier. If not, you'll probably have to do a bit of a Google or a search, for share capital. Try and find it. It's nothing there. Maybe number of ordinary shares or just ordinary shares, and go through and keep scrolling through. Have a look everywhere it brings up. So you can see it's actually already brought me to note 12, which is about equity. And we'll actually have a look. So it goes through and it actually talks about ordinary shares elsewhere. This is actually the note that I need to go to, so it's brought me straight there anyway, which is good. But you can see you can use that search function within your PDF files to try and search. So what I'm looking for is the number. So you can see here it tells me the dollar value, but as well as the number. So there's a balance here. So as at 30 June 2018, I can see the number that were on issue and the dollar value of that number, which I know anyway, the dollar value, because it's listed on the balance sheet. It's also listed in the statement of changes in equity, because that shows me all the changes in the equity items. And one of those equity items is ordinary shares or issued capital as a column, so I would be able to see that. So I know the dollar value. I'm not interested in the dollar value. I'm actually interested in the number of ordinary shares. So I found those in my PDF reports, and most of your companies will list those again in their annual reports. If not, you can go to the stock exchange that your company is listed on, and they will show you the share price and the number of shares, as well as a lot of other company data on those stock exchange sites as well. So if I didn't find it here, I could go through to the Australian Stock Exchange, so www.asx.com.au, and look up Wesfarmers, WES would be the code for that, and have a look at their share, the company research on that. So, okay, so as at 30th of June 2018, these are the numbers that I want. Sorry, this is the number of ordinary shares on issue that I want. For 30th of June 2017, this is the number that I want. 30th of June 2016, this is the number that I want, but I'm also going to check that in the 2016 annual report just to make sure that it was the same. Now, there's one thing that I want to note here before I put these figures into my spreadsheet, and that's the reason that I went back just before and changed the denominations to millions of dollars. It's very important in order to calculate your ratio that's related to this, right, the earnings per share. You need to make sure that whatever your figures are denominated in, that you are expressing the number of ordinary shares in that same denomination. So you'll notice here that Wesfarmers has expressed the numbers in thousands, but the dollar value in millions. So I know that my financials are also expressed in millions of dollars. I need to make sure that I'm also expressing my number of shares in millions. Okay, that's very important. So whatever denomination your financials are in, your number of ordinary shares must be expressed in that same denomination. Now you can put this full number here and then convert it back, or you can just do it in your head and convert it straight in. So if I was to convert, so I know this is the number in thousands, and the difference between thousands and millions is 1,000. So 1,000 times 1,000 is a million. So I know I'm missing 3 zeros. So I'd go 3 decimal points back and enter in 1133.840 to express it in millions. So let's go and set up our spreadsheet. So let's go to the ratios tab, and let's scroll right down to the bottom where it says the workings area. Let's link the years, so I don't have to do that again. Carry it across. It's just, I'm going to have to express this slightly smaller for you. Let's go, say 80%. Okay, maybe 90 even. All right, let's change this to, actually let's format it the same way. So format painter and all of that. Put a line over it. All right, so now we're ready. So let's put number of issued ordinary shares. And we're going to, for 2018, literally take the 2018 figure, which was 1133.840. 1133.840. And it's a number, so let's just format it to a number. Oh, it's done the decimals for me again. Let's put another 2 decimals for the 100th place. So 1133.840. Now again, I could enter this as a whole number, so I could enter, so they had the exact same number as at the previous year. Notice nothing has changed in that year. From the 30th of June 2017 to the 30th of June 2018, they had nothing. No changes. Okay, so I'm going to write in 1133.840 again, so it's exactly the same. So I could write in 1133.840.000 to add in the thousands, and then I could say, well, I know that figure needs to be expressed in millions. So I could, million has 6 zeros, so I could go back 1, 2, 3, 4, 5, 6, and then put a decimal point in there, and then hit enter as well. So I can do it that way. The reason Excel comes up with hash values is because my cell width isn't wide enough. So I'll just show you with this one, 1126131. 1126131.000. Let's just put the full thing in. So it's too, the contents of my cell are too wide to be displayed in that narrow. So I can just rectify that by double clicking. I'll just show you. Double clicking that, and then it widens my cell. Now I don't need to do that because I know I can, my decimals aren't going to be that big once I express it correctly. So I can actually make them smaller. Let's just make them even again. All right. Okay. So now I need to go back to my 2016 annual report and again find the number of ordinary issued shares. So 2016, if I go down to, let's close this search thing for a minute. Go down to my financial statements, make sure it's still note 12. Yes, it's still note 12. Then go down to note 12. And scroll down to note 12 and just have a look. So again, I want this figure here for 30th of June 2016. I'm pretty sure that's the same figure that I just entered in. So 1126.131, 1126.131, yep. So for 2015, I'm going to enter in the balance, which was 1123.753. 1123.753. All right. So that's the first thing I had to find. So that was finding the number of issued ordinary shares. The second thing I need to find is the market price of shares. Now, most companies should list this in the annual report, but some won't. In which case you do need to go to the stock exchange website or another finance website such as Google Finance or Yahoo Finance and search for your company there and then look at their share price is what you're looking for. They usually don't call it the market price of shares. They'll say, what is the share price of this company? And you can, there's usually a chart that you can put dates in and search back to for the share price as at different dates. So I'm going to firstly look at my annual reports. Wesfarmers is pretty good and they do disclose the dollar values, well they have for the last several years. So I'm going to go and check there to start with. Now there's a few share prices listed in the annual report, so I'm just going to have to scroll through till I find the one that I want. Usually you'll see that there's something in relation to like employee schemes. So in this case, this is their key executive equity performance, which is part of their executive management remuneration packages. And they usually issue their shares, or a company will issue their shares to their employees or their executives at a cheaper price than the current market price. It's like an incentive for working for the company, I suppose. So usually if you find a share price listed under that, it's not really a good idea to use that because it's not the actual real listed trading share price. So if you do find that they've listed, for example, performance shares for their executives, this figure here, you can remember that figure and compare it to the actual share price when you do find it, but it's usually slightly less than what the actual share price is. So I don't want that one. I'm going to keep looking. Okay, so here we go. This is, again, it's for their equity awards. So again, to do with remuneration. So they've calculated the weighted average share price, which is basically the share price divided by the number of days, and they weight that every day. So every day the share price is closes at a different amount over the days of a year, and they'll actually average that out. So again, it's not really what we're looking for. We just want the actual, the share price of the trading shares. So not to do with their employees or their executive remuneration. Oh yeah, this looks like a good share price. So this looks like, this is actually the full share price. You have to do a bit of reading and exploring with your annual reports, and they're all going to be different. Just keep having a look because there's still lots of, here it is. So this is good. So this is in their remuneration report, and you'll probably find that your companies may also list out the share price in the remuneration reports or the operational performance reports, just to show how good they are, or if their share price has been increasing. That's always something they like to highlight. They usually won't disclose it if the share price has been decreasing. So closing share price as at 30th of June, it's given that to me literally for the last 5 years. So how good is that? I don't even have to go back to my 2016 report. I can if I want to and just check it. So if I'm just going to check, let's go and have a look and see. Yeah, see here, it actually tells me that we can access the share prices from the stock exchange itself. So your company might be the same. Here we go. So again, it's listed for the last 5 years. So $40.10 and $39.03. Let's check and see. $40.10 and $39.03. So it's exactly the same. So these are my share prices I want. So I've actually found them in the annual report. So I'm going to type all these in. So 49.36. So hang on, that's right. Market price per share, because that's what we're trying to find. So 49.36, and we want that as a dollar value. So change that to dollars. 49.36. Excel automatically does the divide bys when you put something in and then change it. $40.12. So $40.12, then $40.10. And then, what was the last one? I've forgotten. I used to be able to remember all this sort of stuff. $39.03. Kids, I tell you, have a few of them and then your memory goes. $39.03. All right. So that's the second thing we need to find, the market price of shares. The third thing we need to find is the cost of capital. Now, again, I'm going to look in my annual report. I'm going to write WACC for the weighted average cost of capital. If you read the study guide, Martin does say use 10%, and that's fine to use, and I'm probably going to have to use that. But I always just like to check to see, some companies actually disclose the weighted average cost of capital, which is the weighted average of the cost of their capital. So usually companies will fund or get their capital through either debt, so borrowing loans and bonds and so forth, or equity, which is predominantly shares. So, and then they usually have a mix, so they might say have 40% debt and 60% equity. So that's how we fund our assets for operations of our company. So what they do is they say, what's the cost of our loan? So what's the cost of our debt? And what's the cost of our equity? And they'll get a percentage. So, say their interest rate and their debt is, 6%, and then the cost of their equity is 4%. They'll add those two together and divide them by 2 and get an average, basically. I mean, it's a little bit more complicated than that because they do a weighted average, but essentially that's the idea. What's the cost of our debt? What's the cost of our equity? They get an average, and that's your weighted average cost of capital. So All companies will have one, and it's used for a number of purposes, including capital budgeting and capital investing. We'll look at that in one of the subsequent videos that I do. But first of all, I'm just going to quickly go through and just see if I can find some sort of cost of capital for Wesfarmers, because then I can use that. So they do talk about a cost of capital. They do a weighted average cost of capital determined by the prevailing or benchmark market inputs risk adjusted. That's good. Doesn't give me a percentage though. They do have, so I know Wesfarmers does have a cost of capital, but whether I can find it or not in a timely manner is probably not going to be it. Okay, so I can't really find anything in that report, and I know, I'm pretty sure I did this previous years and I couldn't find it as well. But if you search your company and they actually tell you the cost of capital that they use, feel free to use that and write about that in your assignment too, so your marker knows you've had a look, you've actually gone in, you've had a look for their cost of capital, and this is what you're using. Like, you might find their cost of capital is 7.61%, so you can actually use that. In my case, Wesfarmers doesn't tell me, so I am going to use the 10%. 10% would be good. Cost of capital. So they're essentially the three items that I need for every year to make my life easy when I do the ratios. Okay, so scroll back up now. We're going to actually complete the ratios. It's going to be fully linked. There's not one bit I'm going to type in there. I'm going to link completely to the original financials and the restated financials. So I'm going to link to the original financials for this section and then the restated financials for this section. Okay, so the first one is net profit after tax divided by sales. This is my comprehensive income after tax divided by sales. So I'm going to go to my original financials, right down to my income statements, very, very last line. That's what I'm looking for. Now, some students in the past have said, well, that's my comprehensive income after tax. I actually just want to know my profit after tax. I don't want it to include all these other comprehensive items. That's fine. If you choose to do that, just write about why you're doing that. For me, I like to know the very, very bottom line after everything. What's my net profit? How much for every dollar of sales? What have I turned into very final profit after everything, including comprehensive items, have been taken out? So I use this figure. But if you did want to use this one, that's fine. Okay, divided by sales. Now, some of your companies will list out sales. Some of them won't. They'll list revenue like I have. So again, it's not going to make too much difference for me because finance income is such a small amount. So I'm just going to link to my total revenue here. And that's okay to do. If your company actually has listed a sales figure on its own, then link to that one. That's basically all you have to do. Drag it across and it's done. Now, express this one as, we can leave it as a percentage if you like, or we can put it as a dollar figure. Basically, that's telling me for every dollar of sales in 2018, Wesfarmers turned 2 cents into net profit. So that's pretty low in my books. Anyway, okay, so you want to look at the trend as well. So are they trending upwards or are they trending downwards? So, I mean, in 2015 they were turning every dollar of sales into 3.6 cents, and now they're turning it to 2 cents. So the trend's kind of going down. So this is probably not really that favourable. Let's have a look at the return on assets. So same top figure, same numerator, but dividing by total assets this time. So go back to our financial statements and dividing it by total assets, which is in our balance sheet right up here. Hit enter. So again, you can leave that as a decimal, as a percentage. So again, for every dollar of sales, for every dollar of assets, what am I generating into net profit? So for every dollar, so again, you want it to be a higher figure, just like the previous one. The trend is going down, unfortunately. So 5.6 cents in 2015 down to 3.6 cents out of every dollar in 2018 turned into net profit from your assets. So again, the trend's probably not that good. So you want to write about all of these. So as I explained the theory component in the previous section, make sure you're explaining what's going on here in your Word document. Okay, moving on to the efficiency ratios, days of inventory. Now notice there's a few things with this one. So first of all, inventory is on your balance sheet. Go and have a look if you have it. If your company is a service company and it doesn't really do much manufacturing or selling goods, or it's not retailing or anything similar, if it's purely service, you may not have inventory. which is a very small proportion of firms. Even service firms usually have inventory of some sort. So for example, with your hotels, even though they're providing a service like rooms to stay in and cleaning rooms and that, there will still be a small level of inventory. So related to, the consumables in the hotels and so forth. So even if your firm is a service firm, you still may have inventory, so you may still be able to calculate this. But if it doesn't, then you need to talk about in your Word document why you can't calculate it and give explanations for that. So if you don't have inventory, you can't calculate it, write about that in your assignment. If you do have inventory, go to your balance sheet and start linking. So here's my inventories, and I want to divide it by the average cost of goods sold. So again, I want to go back and just state something about that. It's the average daily cost of goods sold. So cost of goods sold is the cost of the inventory when we sell it. So it's basically, when we buy inventory, we list it on the balance sheet, and then when we sell it to our customers, we move it off the balance sheet and put it on the profit and loss statement. And that's what we call our cost of sales. So not always will we call it the cost of sales or the cost of inventory or something. We may actually have different names. It could be called raw materials, inventories in progress, cost of sales, it could be called that as well, cost of goods sold. So there's a number of different names that we can give to this. So you just have a look at what your firm does. This is why it's really important to know your firm. So I know that Wesfarmers has inventory, so I know that they're going to have some sort of cost of sales hidden somewhere on their financial statements. So we have a look, scroll down to the income statements. Some of your companies, they will do what we call a trading statement, which is revenue minus cost of goods sold and minus cost of sales equals gross profit, and then they minus all the other expenses off that. So some of your companies may already list that as a negative up here underneath revenue. Wesfarmers doesn't, and some of your companies won't, they'll list it out here. I can see, looking down, just by having a look at the names of some of these, I can see that this one here is my raw materials and inventory. So that looks like that's the cost of my raw materials. That's the cost of my inventory that's coming out as cost of sales. So this is the figure that I actually want to use. So this is the one that I'm actually going to link to. Now, just show you something with the linking. So I've put in there, I've linked to my inventory first, divided by the average daily cost of sales. So I need to divide my cost of sales figure by 365 days. So open brackets, put my cost of sales figure in, and then divide it by 365, and then close my brackets and hit enter. Okay, now I want it as a decimal point, and I need to also get rid of this negative sign. Now, the reason that it's negative in this case, in some cases you need to leave the sign. You need to know about each ratio and how to interpret it. In this case, we're comparing for a ratio. So I actually don't need it, because the only reason it's negative is I've entered my cost of goods sold as a negative figure, which means nothing in interpreting this ratio. So we'll get rid of the negative sign in this ratio. We don't need it there. Okay, so basically it's telling me how long it's taking to sell my inventory. That's literally, so that the ratio itself is called the days of inventory. So it's saying what is the number of days that is taking us on average from the time we purchase our inventory to the time we sell it. So again, you want a shorter figure, essentially. But not too short, because then that means you could be having stock outs and selling your inventory too fast and missing out on sales because you're actually not holding enough. So you want it to be a smaller figure, but not too small. Okay, so it's remaining relatively constant. So it was taking about 46 and a half days in 2015 to sell their inventory, down to about taking almost 48 days now. So it's slightly slowing down. So again, whether or not that's bad, you need to look at your actual businesses. I'd go to the individual businesses. I mean, Wesfarmers owns a number of businesses, including your Bunnings and your Officeworks and all that sort of thing. So have a look at industry benchmarks. That's what you want to compare to. So have a look at the other big players in your industry and have a look at how they're doing and compare that. You can get those from your industry websites, sometimes from the companies themselves will tell you, or sometimes from your financial stockbrokers. So they'll actually be able to give you, say, out of the industry, these are the bigger players, these are how they're doing. Okay, so that's days of total inventory, days of inventory. Then we're going to look at our total asset turnover ratio. So sales divided by total assets. So again, mine is revenue. If you've got a sales figure, link it. Divided by total assets on the balance sheet, which is here. Okay, so again, this is a turnover ratio. So it's saying out of every dollar of assets, how much are we turning into sales? So for every dollar of assets, we're turning $1.81. We're making $1.81 of sales. So again, whether or not that's bad or good, you need to benchmark against your industry. Having a look at the trend though, I'm seeing a higher figure. So essentially that is, you know, a positive amount. That is generally what I want to see. So for every dollar of for every dollar of total assets, what am I actually turning into sales? Okay. Next one is our liquidity ratio. Very nice, easy one. Current assets divided by current liabilities on the balance sheet. Current assets divided by current liabilities. So again, for every dollar of liabilities, current liabilities, do we have a dollar of current assets to pay for it? And Wesfarmers hasn't for the last 4 years. So they've got less than $1 of current assets to pay for every dollar of current liabilities. That's probably not too good. You'd like to see at least a 1-to-1, or at least slightly more than that. But it is, again, if you look at the industry benchmarks, it's quite common. Okay, financial structure ratio. So this tells us how the company is funded. So remember in the theory component that I talked about earlier, we've got a debt equity ratio, and then we've got an equity ratio and a debt ratio. So the equity ratio and a debt ratio, if I was to put in a debt ratio here, which would simply be debt divided by total assets, these two would add to 100%. So it tells me what percentage is funded by the owners and what percentage is funded by outsiders, such as banks. So the debt equity ratio compares one to the other. So every dollar of equity, how much is an outsider putting in? That's what the debt equity ratio is. So we call debt liabilities in our case. So go to our financial statements and find total liabilities here and divide it by total equity here. So you can see it's 62. So for every dollar that an owner's putting in, a bank is putting in 62 cents. So have a look at the trend. It's pretty much remained constant. I mean, jumped up in 2016 and slowly coming down again. Okay, so equity ratio. Let's go and calculate the equity, which is equity divided by total assets. Equity divided by total assets. And let's have a look at the debt ratio, which is debt divided by total assets. Now you don't have to do this one, I just want to illustrate. So debt being total liabilities divided by total assets. I just want to illustrate what I was saying in the lecture, which is that these two added up together will equal 100%. So you're literally just with a debt ratio and an equity ratio, these ones here. I'll just highlight this one. You don't have to do this one. The debt and the equity ratio together add up to 100%. So that shows you what percentage is funded by the owners and what percentage is funded by the outsiders. And again, if you look at the original 38.66 up to 38.39, pretty much constant, slightly increased and then decreased. So this tells me, the trend tells me that they borrowed a little bit and they're slowly repaying it back now to the outsiders. So their debt is decreasing essentially. But overall, the trend in the past 4 years has remained fairly constant. They've pretty much got their debt levels back to where they had them in 2015. So debt equity ratio compares these two against each other. Tells us for every dollar that the owner is putting in, how much is an outsider putting in. Okay, so moving to the market ratios. This is where all of our hard work earlier comes in handy. So we're going to calculate earnings per share. Now, if you go to you'll notice your company's actually already calculated for you. Let's go to the income statement. So on your company's income statement or comprehensive income statement, right at the bottom you'll see this lovely little section, the earnings per share. And they've got basic and diluted earnings per share. So your company calculates earnings per share as what we're going to do, so net profit divided by number of ordinary shares out there. What they're calling basic earnings per share is what we generally call earnings per share, what we're going to calculate. Diluted earnings per share, they actually say, well, of all the number of shares, ordinary shares on issue, what about all the ones that could be on issue? So the number of ordinary shares that are currently on issue, some of them have rights and options and warrants attached to them, which can be exercised by the owners who own those shares or rights. If they exercise those, they could create more shares. So I might own shares and it gives me a right to opt in to create 2 more shares after a certain event or after a certain date. So in actual fact, instead of just owning 1 share, eventually down the track I could own 3 shares. So a diluted earnings per share is basically, let's look at all the shares currently on issue, plus all of the possible shares that could be on issue, add them all up, that's our potential number of shares on issue, and divide net profit by that larger figure. Because the denominator is a larger figure, it dilutes the net profit per share. So that's why they call it a diluted earnings per share. Okay, so we're going to calculate our basic earnings per share. And again, your companies will be slightly different to what you calculate because they do a weighted average. So they do a weighted average of the number of ordinary shares on every day. So the number of shares that are traded can change every day. So they'll do a weighted average over the year and then use that weighted average figure to divide your net profit by. And that's how they calculate theirs. We're not going to do that. We just take one figure. We just go right at the end of balance date, what was your shares on issue? And we put them down here. And that's all we're going to divide net profit by. So let's do it. So I'm going to go right down to the bottom. Use this figure, divide it by the number of shares on issue, which thankfully I expressed in millions. So it's nice and easy for me now. Pull it across. That's my earnings per share. So again, having a look, how have we gone for shareholders? For every share that's on issue, have we increased profit over the years or have we decreased profit? So the trend, 2016 looks like there's an anomaly there. It's really gone down to 29 cents. So earnings obviously were very low in that year because the number hasn't really changed. But overall, we were $2 per share earning. So for every share that was outstanding, was the net profit, if we divided it up into all of the shares, was giving us $2 per share. Now it's only giving us $1.19. So again, the trend's not too positive. What's the other thing I wanted to say on that? Oh, the anomaly. So in 2016, notice how this is really odd, this funny figure. Always check out funny figures. So remember your ratios are just like little red flags, like something might need to be checked out here. So go and have a look and see why in that year, and we could see that looking here as well at our profitability ratios, something went wrong or not quite as normal as every other year. So that's a good reason to go back and actually check and see what's going on in the 2016 year in particular. For this one, obviously it's related to the net profit. So you would actually go back to your financials and have a look and see, okay, well, in this year, look at our profit. In the other years, we've made, well, over $1 billion worth of profit. But yet in this one, we only made $407 million. So what happened in that year? And again, that's impacted on the comprehensive income, which is why our ratios are so much lower in that year. So you could have a look and have a look at the trend of revenue. Has it been really the revenue? No, not really. Then have a look at the expenses. So they had a lot higher raw materials and inventory in that year. Did they have a different supplier, a different contractor? Just sort of have a look why it was so high. And also with other expenses, looks like they had slightly more in that year. All of which has actually impacted their net profit figure. So it's important to go back and have a look. If not, if there's been nothing that's really out of the ordinary, they just had a bad trading year, which is what it looked like in the case of Wesfarmers, then we can go, this is what we were talking about back in the lecture, the impact of one-off non-recurring items. So there might have been something that was in that year that they didn't experience in another year. So you can just actually ignore it. It's an anomaly for 1 year, and let's not look at that. Instead, let's focus on the trend of what's happening rather than going, oh, they really fell down in this year. Let's look at the trend. It was $2 up to $2.55, back down to $1.19. So again, not really trending in the direction we wanted, and talk about that. Dividends per share. So earnings per share is how much net profit we earned, the company earned for every share on issue. Dividends is how much they paid out of that profit. So most companies usually don't pay out very much of this. Wesfarmers actually does. Okay, so it's one of our nice secure firms to invest in. It's usually in a lot of the the less risky portfolios. If you're doing a bit of financial investment, you'll find that Wesfarmers is listed alongside a number of the banks, and usually it's included in one of the the safer or less risk averse portfolios, and it does pay good dividends, so it likes to keep its shareholders happy. So you can find dividends, so it's dividends divided by the number of issued ordinary shares. So dividends is always found in your statement of changes in equity, if they pay any. So we'll go down, it's in the transactions with shareholders section. It's usually the last transaction with shareholders, which in Wesfarmers' case it is. And they pay large amounts of dividends, which you can see. It's actually not common for a company unless it's very old and very established. And even then, it's got to be making good profits every year. It's not likely that they actually pay that very much. So Wesfarmers does, your company might not. So it's dividends divided by our number of ordinary shares. So again, we've done that work for us, for ourselves. Now again, you can get rid of this negative figure. It's negative simply because my dividends figure is negative. We don't need to know the negative for this. It doesn't impact at all. So let's get rid of it by putting a little minus sign. And have a look at that. Now, your company, when you calculate it, will probably be something like 0.02. Wesfarmers is $2.23. So that's what I'm saying. Like most companies, you'll find they've got a really, really small dividend amount that they actually pay out. So you probably find it's something like, 2 cents or 20 cents if you're lucky. It's less common to find a company like Wesfarmers who actually pays out a lot of their earnings. In some cases, more than 100% of their earnings, which is probably not recommended for long-term sustainability. But anyway, so looking back in 2015, they paid $2.31. They actually only even earned $2 per share, and yet they paid out $2.31. Same with 2016 when they had a shocker year earning this. In 2017, they earned more than they paid out, so yay. And this year, 2018, they paid out more than they'd actually earned. So they only earned $1.19 per share in profit, yet they paid out to shareholders $2.23 per share. That's a lot. So again, just have a look and explain your ratios why. Now your price earnings ratio, again, this is something that we totally link here. So it's the market price per share that we found divided by our earnings per share figure. So this one up here that we've calculated already. And that's basically saying, as my student who told me I explained it too difficult in the theory in the lecture, if he was explaining this, he would say, okay, well, back in 2015, it would take, if I was to buy a share back then, it would take me 19 and a half years to be paid back for my investment. If I bought a share in 2018, it would take me almost 41 and a half years to be paid back for my investment at current earnings. So, that's the way he would explain it. To me, I like to see a lower price earnings ratio because that means it's priced better for the earnings that I'm actually going to get as a return. So it's basically saying, this is, if you look at the actual formula, this is the amount I've paid for the share, this is the market price, this is how much that share is earning me. So, if your share's $5 and your market price is $1, then it's going to take you 5 years of $1 earnings to get back your $5 that you paid for that share. So I like to see a lower price earnings, but a lot of managers like to see a higher price earnings because in the market, a higher price earnings ratio signifies expectation of future profits and profitability. So, which view is right? Depends on your stance and depends on what you're using the ratios for. So again, these are all just tools, not telling us that something's good or it's bad. It's just simply a tool to guide you. So again, this is all stuff you can be writing about. Okay, so that's all the ratios calculated for our normal financial statements. Now we're going to calculate these final ratios based on our restated financial statements. So moving first for the return on equity. So for every dollar of shareholders or owners' funds that they put in, how much have they turned into net profit? So we're using our restated financial statements tab. Now I don't want to see anything linked to the financials, the original financials here, all about the restated now. So it's the comprehensive income divided by shareholders' equity. So scroll down to your income statement, comprehensive income divided by shareholders' equity, which is the same as total equity from our original financials. But let's link to our restated and drag it across. So for every dollar of shareholders' equity, they were turning 9 cents into net profit. Now they're only turning barely 6 cents. So again, the trend is not too positive overall for Wesfarmers. Okay, do you see why I said in the previous videos to use acronyms? Okay, look at how easy this is going to be. OI divided by NOA. All you have to do, if you've written your acronyms in when you're doing your restated financials, is go and find OI and divide it by NOA. So OI is in your income statements. Scroll down till you find OI, and here it is for me. Divide that by NOA, which is in your balance sheet. So again, find where you've written NOA and hit it in. So easy. Otherwise, you're going to try and find, where's my operating income after tax? You have to scroll through all your financials, have a look and see which total it was, and then you forget if it's not this one, is it this one? So if you use your acronyms, it makes life a lot easier. Now, this one here, you can actually compare it to, and I'll write this here, compare to your return on assets from above. And this will remind you to, when you're doing your spiel in your Word documents, to compare to this baby. So we want to see, the difference down here is we've actually separated out the operating items from the financing items. Up here, all of our ratios have included financing and operating together. Down here, we've separated them out. So now that we've separated operating assets out of total assets, have a look at how we're doing really. So 8%, which is a lot better than the 5.6%, 1.5 instead of 0.8, 10.37 instead of 7.2, and 5.53 instead of 3.6. So you can see we're actually, once we've separated out the operating side of the business, we can actually see a better or a more accurate reflection of their return on operating assets. So they're actually generating a better return that was originally indicated, but still the trend is going down, which isn't very positive. Okay, net financial expenses divided by net financial obligations. You know what? This should have, to make life easier for everybody, this is what it should have. NFE divided by NFO. And guess what? If you've done your acronyms, this is how easy it's going to be. Now again, if you've got NFI, which was your net financing income, divided by your net financing assets, then again you just use, the interpretation is going to be the same, just obviously not for a loan. It's more like having cash in the bank and getting an interest on cash in the bank. In this case, for Wesfarmers, it's going to be like your borrowing costs. Like you go for a loan, what's the interest rate cost? So equals NFE, right here, divided by NFO, which is in the balance sheet, right here. So again, we don't need the negative in this case. The only reason it is negative is because I've actually listed my NFE as negative down here. So the only reason is because this is listed as negative. We don't need to worry about that. So let's negate that. We're looking at the ratio between them. So the borrowing costs, again, if we have a look, it's 3.58%, slightly decreased to 3.36%. So I would expect that because the level of borrowings have remained slightly the same. But have a look here. This is a little bit interesting for me. In the years, I've just noticed up here from memory, when we did the debt ratio, and again, you could see it when we calculated the debt to equity ratio. From 2015, the outsiders started funding a bit more of the company in 2016 and 2017. So there was a real jump between 2015 to 2016, and now we're slowly starting to pay it off. That's what it looks like. But they did borrow a little bit in this year. And you can see that again in the debt ratio I calculated just to make it obvious. They're at 37% funded outside, and suddenly they went to almost 44%. So they did do a bit of borrowing here. So I would have imagined perhaps their borrowing costs to slightly increase, maybe stay the same. But look what it's done. It's actually decreased. So it was 3.58 and it's decreased to 1.92 in that year that they borrowed. So that's actually pretty good. It tells me, as an outsider doing these quick figures, that in general, Wesfarmers borrowed a lot of money, but they got it at a cheaper borrowing rate. In fact, that's a pretty darn good borrowing rate. And then as they're paying it off, it's starting to increase again. So really, I mean, it's good that they're paying down debt, but perhaps they could be looking at, what are they paying down? Are they paying the more expensive costs, the loans down, or are they actually paying the cheaper ones down? It looks like they're paying the cheaper ones because the cost of debt's actually increasing. So whilst the trend remains the same, and the trend is positive because the general cost is decreasing, if you had a look at what happened, they obviously borrowed a lot more in this year. We might have to look into perhaps, looking at different sources or looking at the cost of each of those sources of borrowing in that year. Because that was pretty good. Like, they borrowed a heap of money and yet, they significantly decreased their borrowing rate. So anyway, that was something interesting. I thought, if I was writing my assignment, I could talk about that. All right. Now, so the profit margin, this is one of the drivers, hint, of economic profit. So we're going to calculate it. Operating income, so OI divided by sales. So again, OI, let's go and find OI. Here it is. Divided by my revenue, which is way up here. So I'm going to... Now, again, you can choose whether you're doing revenue or the total operating income. I'm just going to choose revenue. And if you've just got a specific sales item, you can just link to that one as well. And pull it across. So again, this one you can compare to, I'll put it in here so you remember, compare to your net profit margin from above. Right, the very first one we did. Because remember, we've separated out here operating income. So we've separated out the operating side of it. We haven't included the financing. For me, there wasn't too much. There was really only finance income that I separated. So if you have a look, you've got profit margin after sales. So 3.6 to 3.92, and then in 2018, a 2% to 2.2%. So when we separate out the O and the F down here, we separate out the operating items, we can see we've slightly improved or increased the profit margins. For every dollar of sales, we've increased how much we're turning into profit. But still, that's still fairly small. 2%, that's 2 cents. So 2.2% is 2.22 cents. So it's still fairly small. And again, the trend, what's happening? So probably not the most positive thing. Okay, asset turnover. Again, with this one, you can compare this, and I'll write it here again, compare to the total asset turnover ratio. ATO is not the Australian Taxation Office, for those working in the industry. We call it asset turnover here. Another one you've got to remember. So compare that one to this ratio that we calculated above. So for every dollar of assets, how much are we generating in sales? So for every dollar of operating assets, how much are we generating into sales? So again, let's go and link it. Sales divided by net operating assets. So revenue divided by NOA. Love that I've separated out my acronyms. So slightly better, and you would expect it to be slightly better because we've separated the operating assets out of total assets here. So slightly, so $2.05 compared to $1.55, and then in 2018, $2.49 as opposed to $1.81 that we're generating in sales out of every dollar of assets. So slightly better, as we would imagine, because our profitability was also trending the same way. But let's have a look over the years. $2 to $2.40, that's pretty good. It's actually increasing. So we're using our assets more efficiently, even though we're not generating as much profit. We're actually using our assets slightly more efficiently, which is pretty good. So that's a positive trend. It's not a huge trend though. I mean, $2.05 to $2.49. But hey, an increase is an increase. So make sure you compare to the original financials as well. That's pretty much all of your ratios done. Now, the next one we're going to calculate is economic profit, and that's a whole baby on its own. It gets its own separate marks. Have a look at the marking criteria, and it gets its own separate section for an explanation. So you get to show off a bit if you know about economic profit, and I'll talk about it a bit in the theory section before. So I won't do too much now, but essentially you get 2 marks just for doing this calculation. So it's the return on net operating assets, which we have already calculated above. So open your brackets and click in there. This is RNOA, and RNOA, this is the actual one we want. So we've already calculated our return net operating assets. Minus the cost of our capital, which we found and put down here, made life easy for ourselves. Close brackets, times by our net operating assets. So little asterisk and click into net operating assets on your restated financials. Now, don't negate this negative figure. We want to leave that there. This actually, we need to know whether it's negative or positive. It actually makes a difference whether it's negative or positive for us, because there's no negative figure we've entered here. What the negative is telling me is that my return on net operating assets is less than my cost of capital. So if it's negative, that's what it's telling me. If it's positive, it's telling me my return on net operating assets is greater than my cost of capital, which is what you want, essentially. So, you know, we're going out and funding this entity, that's the cost of our capital. Are we getting a return for it on the operations? So hopefully you will see a positive figure here. If there's a negative figure, then you got some issues. So it's not very good with having a look at Wesfarmers. Now, again, having said that, I didn't find their cost of capital. I'm just using 10%. So again, if I actually went and found their cost of capital, and we found, like, say, their cost of capital was, 4% here, 5% here, 6% here, and 7% here, then it would make a difference to these figures. Okay, because it's comparing my weighted average cost of capital with my return on net operating assets. So it's basically saying what percentage am I earning greater than my cost of capital, and then timesing that percentage figure by my net operating assets as a dollar figure, just to get my dollar value profit, essentially. So that's what it's. So always think yourself through the actual formula. I don't need to. I'm just going to use 10%. So let's have a look at the trend. Am I increasing my economic profit? No, not really. And I would have expected that, because look, have a look at the trend of my return. 8% down to 5.53, so it's trending the wrong way, and I can see that in dollar value. So these are actually dollars. You can change that to dollars if you like. 592 million down to, up to 1.2 billion. Not very good. So the trend again is in line with previous ratios, telling me what's going on. So this is the sort of thing we want you to ask why. We want you to think about why. I want you to talk about why with all your other peers, because just listening to me blah 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 about my views and my expectations isn't going to be something you're going to remember. Making it personal and asking the questions you have questions about and getting those answers for yourself and talking about them with other people, that's what you're going to remember. So that's it. That's pretty much calculating all the ratios. Don't forget, you do have the written component, which is a large section of the marks, not just calculating this spreadsheet. Make sure that you're writing down in your Word document all of the explanations. So comparing your numbers down for each year, across the years. So for trends, what has this been trending between each other? So for example, from your, comparing your return net operating assets to your return on assets from your normal financials, as well as what does this mean for the firm as a whole? So what does this mean for Wesfarmers as a whole? And connecting a story, telling us a story about your firm. So that's what we want you to write about, and that's what we're looking for in the written component. So once you finish this, make sure you do the written component, and then you can move on, and I'll see you in the next video.